Let's shift our focus to US markets now. Wall Street stocks are surging to new highs. Oil prices are certainly not back to their lows, and neither are interest rate expectations. Well, one of those things surely can't be right, can it? In this next report, we decode what investors could be getting wrong about central bank policy as we build to another big week in global markets. Take a look.
One of many striking features of markets right now is the gap between stocks and oil prices. Wall Street stocks have shrugged off their mid-war losses and are surging to new highs. Oil prices remain well above pre-war levels and, by extension, central banks' expectations. It's hard to believe both are right. When it comes to the way investors are thinking about central banks, it looks particularly difficult to square with fundamental market views. First, Fed rate hikes. Markets now think rates are more likely to go up than down, albeit marginally, after weeks of pricing cuts. The spread between US and Eurozone interest rates has widened. The scale of repricing since the war began now looks identical in both regions. That's a change. For several weeks, the working assumption was that Europe faced a much more severe inflation shock, warranting greater tightening than in the US. Why the shift? Eurozone data has undershot expectations while the US has held up better. The recovery in Wall Street stock weakens the case for near-term cuts, and the Fed itself has made a concentrated effort to talk up market rate expectations. With several officials keen to ditch the easing bias, but the US growth is heavily concentrated. Private health and social care continues to account for a large portion of job creation, but both those sectors account for less than 20% of total employment. Separately, the UK repricing looks strange. Interest rates are now seen more than a percentage point higher in a year's time than before the war. That is around 0.4% more than the equivalent ECB repricing. That partly reflects the experience of 2022 when Britain emerged with a bigger and more persistent inflation problem. The UK is often described as being particularly sensitive to energy shocks. Markets still appear to be overplaying the energy channel. Expectations for the ECB and BOE are still trading very tightly with oil prices. The big event in the coming week will be Jerome Powell's final day as Fed chair, with Kevin Warsh taking over on Friday, May 15th. Investors will also closely watch U.S. retail inflation data on Tuesday for more clues. A second consecutive 0.9% month-on-month print is expected at the headline level. That is attributable mainly to the surge in gasoline and diesel prices. Higher airline fares will also contribute, while a rebound in medical care and recreation risk a 0.3% for core inflation reading that will push the annual rate up to 2.7%. However, analysts continue to believe the headline surge is temporary, given the lack of demand impetus that would risk broader, more persistent inflation. This is Bureau Report. WION World is One.